Is the September rally in the US dollar over? Is that all there is to it? Just 1 month?
The September rally in the US dollar index was just a technical rebound, driven in part by short covering. But the fundamentals underlying the dollar suggest lower levels over an extended period. Now, of course, there will be other little rallies for the US dollar, but these rebounds will likely see the US dollar index, the DXY, trade in a series of lower highs and lower lows.
This pandemic was supposed to have driven the US dollar higher. It was supposed to have caused a shortage of dollars due to a shutdown of businesses. Yet, over recent months, you have been saying the dollar is now on a multi-year decline. Why?
Well, what changed all of that was the extraordinary amount of new US dollars printed by the Federal Reserve to fund government spending in the US to cope with the pandemic. The US expanded its M2 money supply 22% for the year of September, compared to around 15% for the Euro area, 11% for the United Kingdom, 7% for Japan, 6% for China. This massive monetary expansion has turned what should have been dollar shortage into a dollar glut.
What is the role of interest rates here?
Well, the US Federal Reserve has abandoned its traditional target of 2% inflation. It now says it's targeting 2% average inflation over a period of time, which means it will tolerate inflation above 2% for an extended period of time before it starts raising its interest rates. So if you look at a recent Federal Reserve forecast, it is expecting 1.55% inflation in 2021 and 1.7% in 2022, which suggests that the earliest we are likely to see the US hit 2% inflation will be 2024. Now remember, the Fed's new policy is to allow an overshoot of 2% inflation before it raises interest rates, which means it could well be 2025 before the Fed raises its policy rate above zero. And zero US rates for longer means a lower US dollar for longer.
How much longer?
Well, the US dollar index, the DXY, has over the past half a century run 3 full cycles of approximately 16 years each. And each cycle has seen a series of lower highs and lower lows. The total length of a complete up and down cycle averages 15.7 years. The up legs average 8.2 years and the down legs average 7.5 years. We now appear to be in the early stages of another down leg, which started early 2017. Now, if the historical average repeats itself, this down leg could last until 2024.
Which is when you think the US will see a 2% inflation.
That's absolutely right. And that may be about the time when the currency market starts thinking about higher US rates and a stronger dollar. So we still have more years of dollar decline ahead of us.
So, which currencies will benefit from the US dollar weakness?
The euro, being 57% of the US dollar index, will be the most obvious beneficiary if the DXY falls. The Aussie, the Australian dollar, whose fortunes are linked to Chinese economic growth, may be another long-term winner. And the renminbi could be another winner as well, given China's stronger economic growth and its more conservative monetary policies.
We have to leave it there. Thank you, Simon.
Thank you.